So the share price reactions that we saw yesterday, I think quite interesting. Comcast shares reacting negatively and Sky obviously surging to right around the offer level. Just to remind everyone, it's not quite over yet. We are now heading toward the tender process whereby Comcast has to secure more than 50% acceptance from Sky shareholders for the deal to go through. And one thing that we know, Comcast was in the market yesterday looking to make market purchases to try to control that situation as best they can. Assuming they were successful in acquiring shares, we should get a disclosure likely sometime today around that. But in terms of the deal itself, yesterday plenty of debate around whether or not Comcast has overpaid for these assets and around the long-term merits of the deal. So Zach, you could potentially weigh in around what do you think of the price paid? Did they overpay?
Well, I think the important thing to remember is this would have been an absolute PR disaster for Comcast had the deal not gone in their favor. I mean, they needed to prove that they could grow beyond their US pay TV contingent. They've gone and acquired 10 million pay TV subscribers in the form of Sky, high margin business, the beachhead, if you will, of the European pay TV business. Whether or not they've overpaid, I mean, that's a fair question, but we really have to ask, what was the alternative? There are so few of these media assets that really Comcast could come in and purchase and actually meaningfully make a difference to their business.
Can you just clarify your comments here? And I find it very interesting. International beachhead in a sunset business. Are you implying that Comcast has bought a business in a sector that is actually dying?
Well, pay TV, it's no secret, it is in perpetual decline. We've seen the shift towards OTT services such as Netflix. They're gaining enormous popularity, particularly in younger demographics. Where pay TV is enormously robust is in the form of those older demographics that are still paying these huge margins for their content, and that's really what Comcast have gone and acquired.
So effectively there's a cash cow still that the business can use while it looks for new ventures. And I think that was a really interesting point that you've been making in some of your research, that this allows Comcast to go after more research and development or come up with ideas to move towards the new economy that we're seeing in digital and for content.
Absolutely, absolutely. This has a precedent actually in media acquisition. So just last year, Bertelsmann, the German media company, they went and upped their stake in Penguin Random House. Now, I don't think anyone thinks that this means that they think that book publishing is going to be the future of media. What it does mean is that they've recognized this asset is likely to pay out far more consistent margins, particularly in a notoriously volatile industry such as media. You can then go and take that capital and reinvest that in far riskier digital ventures, which ultimately will be the future of your business.
Well, let me ask you, how do they get their money back on this deal? Does it involve lots of cost cutting, or is there a way of growing into the cost?
You would imagine it would involve more on the cost cutting side. So you would believe that they're going to find a way to lower their cost and keep that notoriously sticky Sky consumer base.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.